Financial crises. Can they be prevented? Introduction. Financial crises have been recurring events in the history of global economies, often leading to severe economic downturns, massive job losses, and social unrest. These crises are typically marked by the collapse of financial institutions, sharp declines in asset prices, a halt in lending, and a reduction in overall economic activity. They have far-reaching consequences, affecting not only the financial sector but also employment, investments, and the broader economy. The most notable financial crises include the Great Depression of the 1930s, the Asian financial crisis of the late 1990s, and the global financial crisis of 2007 and 2008. While various policies have been implemented to prevent financial crises, questions remain as to whether they can truly be avoided. This article explores the nature of financial crises, the measures taken to prevent them, and whether they can indeed be completely prevented in the future. Number 1. Understanding financial crisis. A financial crisis refers to a situation where the value of financial institutions or assets drops rapidly, causing widespread panic and disruptions in the economy. These crises can arise from multiple factors, such as the collapse of large financial institutions, excessive risk-taking by banks, speculative bubbles in the housing or stock markets, or a sudden shock to the global economy. While financial crises have many causes, they are often exacerbated by a lack of transparency, poor regulation, and an interconnected global financial system. This section will define the concept of financial crisis and examine the different types such as banking crisis, currency crisis, and debt crisis. Number 2. Historical precedents. Financial crisis through time. Throughout history, financial crises have been triggered by various factors, including speculative bubbles, over-leveraging, and institutional failures. Some of the most infamous financial crises include the 1929 Wall Street crash that led to the Great Depression, the 1997 Asian financial crisis, and the 2008 global financial crisis. These crises have had lasting effects on the economies and societies affected. This section will explore notable historical financial crises, providing context for understanding how and why they occurred, and highlighting the lessons learned from these events. Number 3. The causes of financial crisis. Financial crises can arise from a multitude of factors, often intervened. Common causes include excessive risk-taking, poor regulatory oversight, sudden economic shocks, and imbalances in the financial system. For example, the 2008 global financial crisis was largely caused by a housing bubble and excessive subprime mortgage lending, combined with inadequate risk management by financial institutions. Similarly, currency crises often stem from speculative attacks on a country's currency, driven by imbalances in its economy. This section will delve into the primary causes of financial crises, identifying the key factors that contribute to their onset and highlighting the role of both public and private sector actors. Number 4. The role of financial institutions in crisis. Banks and other financial institutions play a central role in both causing and mitigating financial crises. During periods of economic stability, banks often engage in riskier lending practices and speculative investments, which can lead to the accumulation of unsustainable debt levels. However, when a crisis strikes, these institutions can exacerbate the situation by failing to manage the risks properly, or by contributing to panic among investors and depositors. This section will examine the role of financial institutions in financial crisis, analyzing how their behavior can either prevent or trigger a financial meltdown. Number 5. The role of government and central banks. Governments and central banks play a crucial role in both preventing and responding to financial crises. The implementation of sound regulatory policies, robust banking supervision, and emergency financial measures can help prevent crises from developing. For example, after the 2008 global financial crisis, central banks like the US Federal Reserve and the European Central Bank enacted extraordinary measures such as interest rate cuts, quantitative easing, and bailouts for financial institutions. However, government interventions can sometimes create moral hazards or encourage excessive risk-taking. This section will discuss the role of government and central banks in both preventing and managing financial crises, focusing on their success and failures in recent years. Number 6. Financial regulation and its effectiveness. One of the most important tools for preventing financial crises is robust financial regulation. Regulations are designed to ensure that financial institutions operate in a sound and transparent manner, mitigating the risk of systemic failures. After the 2008 financial crisis, significant reforms were introduced to tighten regulations in key sectors, such as the banking industry, with the passage of laws like the Dodd-Frank Act in the US. These reforms focus on increasing transparency, limiting risky practices, and establishing a framework for dealing with failing institutions. However, critics argue that regulation alone may not be enough to prevent crises, as financial innovation can often outpace regulation. This section will evaluate the effectiveness of financial regulation in preventing crises, examining both the successes and shortcomings of regulatory measures. Number 7. The role of globalization in financial crises. Globalization has interconnected financial markets, making economies more vulnerable to external shocks. A financial crisis in one country or region can quickly spread across borders due to the interconnectedness of financial institutions, investment markets, and supply chains. The 2008 global financial crisis is a prime example of how a crisis in the US housing market triggered a global recession, affecting countries around the world. Globalization also facilitates the flow of capital and trade, which can contribute to the build-up of financial imbalances. This section will explore the role of globalization in amplifying financial crises, examining how the interdependence of global financial markets can create vulnerabilities. Number 8. The importance of transparency and information flow. A lack of transparency is often a key contributor to financial crises. When financial institutions or governments withhold or distort critical information, it can lead to an erosion of investor confidence, creating panic and accelerating the crisis. The 2008 crisis, for example, was exacerbated by the lack of transparency surrounding the mortgage-backed securities and other complex financial products that banks had been trading. Ensuring transparency in financial reporting and improving information flow is crucial for maintaining stability in financial markets. This section will examine the role of transparency in preventing financial crises, discussing the importance of accurate and timely information in maintaining market stability. Number 9. Risk management practices and their limitations. Risk management practices are essential for identifying, assessing, and mitigating potential financial risks. However, during times of economic growth, businesses and financial institutions may overlook or underestimate risks, believing that the good times will continue indefinitely. In some cases, institutions take on excessive risk to maximize profits, as seen in the lead-up to the 2008 financial crisis. Furthermore, financial innovations such as derivative products and securitized assets can introduce new, unforeseen risks that traditional risk management strategies may not account for. This section will explore the role of risk management in financial crises, identifying the limitations of current practices and offering recommendations for improving risk mitigation in the future. Number 10. The impact of speculation and market behavior. Speculation plays a significant role in the formation of financial bubbles and the subsequent crashes. Market participants, driven by the hope of high returns, often overestimate the value of certain assets or sectors, leading to unsustainable price increases. When the bubble bursts, the resulting collapse can trigger a financial crisis. For example, the housing bubble that led to the 2008 financial crisis was fueled by speculative investments in real estate, driving up property prices to unsustainable levels. This section will analyze the impact of speculation and irrational market behavior in triggering financial crises, discussing how speculative bubbles form and how they can be prevented. Number 11. Crisis management and recovery. Once a financial crisis occurs, managing the fallout is critical to restoring economic stability. Governments and central banks must respond quickly to stabilize financial markets, protect financial institutions, and prevent a full-blown recession. Measures may include bailouts for failing banks, fiscal stimulus packages to support economic growth, and changes to monetary policy to encourage investment and spending. In the aftermath of a crisis, recovery can take years as businesses rebuild, unemployment rates decrease, and markets regain confidence. This section will discuss the strategies employed during financial crises to mitigate their effects and support long-term recovery. Number 12. Can financial crises be prevented? While no system is foolproof, there are significant efforts underway to prevent future financial crises. These efforts include stronger financial regulations, better risk management practices, improved transparency, and enhanced cooperation between governments and financial institutions. However, the nature of financial markets means that some level of risk and unpredictability will always remain. Financial crises are often caused by unforeseen events or the accumulation of complex factors that cannot be fully anticipated or controlled. This section will address whether financial crises can truly be prevented or if they are an inherent part of the economic cycle that must be managed and mitigated. Number 13. The role of technology in preventing financial crises. Advances in technology, such as artificial intelligence, big data analytics, and blockchain have the potential to improve financial monitoring and risk management practices. For example, AI can help financial institutions identify early warning signs of instability or financial fraud, while blockchain technology can increase transparency and reduce the risk of fraudulent activities. These technological innovations offer new ways to prevent financial crises by improving information flow, reducing human error, and increasing regulatory oversight. This section will explore the role of technology in crisis prevention, discussing how technological advancements can be used to strengthen the financial system. Number 14. Conclusion. Balancing risk and stability. While financial crises can never be completely eliminated, significant progress can be made in reducing their frequency and severity. By strengthening regulatory frameworks, improving risk management practices, increasing transparency, and using technology to monitor financial systems, we can reduce the likelihood of crises occurring. However, as history has shown, the global financial system will always be susceptible to shocks, and the best we can do is to make the system more resilient. In the end, preventing financial crises is not about eliminating risk entirely, but rather about managing it effectively to protect economies and individuals from the most devastating consequences. Conclusion. Financial crises are an inherent part of the economic landscape, shaped by the complexities of global markets, human behavior, and unforeseen external shocks. While it may not be possible to fully prevent them, the lessons learned from past crises and the measures implemented to address them have made the financial system more resilient. By continuing to improve regulations, transparency, and risk management practices, we can reduce the frequency and impact of future financial crises, ensuring greater economic stability and protection for individuals and businesses alike.